If you happen to share a bank account with your husband, wife, son, daughter, or any other person you care deeply about, I'm asking you to pause your scrolling for just a few minutes. Because what I'm about to reveal could rescue your loved ones from a financial disaster that the vast majority of families never anticipate until the moment it's already happening. There's a silent issue lurking inside millions of joint checking and savings accounts throughout this nation at this very moment. And hardly anyone speaks about it until the day everything falls apart. By the time this video ends, you'll know precisely what that concealed danger really is, why banks seldom alert you to it, and what steps you can take within days to safeguard the savings you've spent your whole life earning. Stick around, because the single most crucial piece of this discussion arrives toward the finish. And you truly don't want to skip it. Welcome back to this channel created for folks who want honest, direct guidance on money matters, retirement planning, and defending what they've built. If you're new here today, do me a small favor and click that subscribe button now, because these kinds of practical financial subjects come up here every single week. And believe me, staying tuned is worth your time. All right, let's dive in. Here's a fact that catches most folks off guard. When you set up a joint bank account alongside someone else, you're not merely putting an additional name onto a document. You are surrendering complete and equivalent authority over every single dollar within that account, beginning at the very second the account is created. It makes no difference whose funds those actually are. It makes no difference who put the money in, who set it aside, or who spent 30 or 40 years working to accumulate it. The second another name is placed on the account, that individual generally holds the identical legal power to pull out, move, or use every penny inside that account just like you can. The majority of older adults believe a joint account simply streamlines everyday life. Handle the bills as a team, manage matters if mom or dad falls ill, keep things straightforward. And in many situations, that really is how everything plays out. However, in 2026, as banking regulations evolve, fraudsters grow craftier, and relatives live farther apart than in previous generations. That easy setup can transform into a genuine crisis. And it typically unfolds silently, without anyone catching on until the harm has already been done. Let's begin with the most typical motive families set up a joint account originally. A parent gets on in years, perhaps facing some medical worries, and hopes to make things simpler for a grown child to lend a hand with bills or handle affairs when necessary. That seems fair. It feels like the right move. But here's what almost nobody spells out clearly at the moment that account is created. There are actually multiple methods for adding another person to your account, and they aren't identical. Even though financial institutions frequently process the documents the same way. One choice is what's occasionally referred to as a convenience account, where the added individual can sign checks and settle bills for you, but they don't genuinely own the funds, and they have no entitlement to it once you're gone. The alternative choice is a genuine joint account with rights of survivorship, where the added individual becomes a complete legal owner of every dollar right away. And once you die, that money passes directly to them automatically, no matter what your will states. That final piece is where matters become tangled, and it lies at the core of why this subject is so critical at this moment. Imagine this. A widow has 3 grown children. She intends her estate to be divided equally among all 3 when she dies, and her will states precisely that. But some years back, she added her eldest boy to her checking account merely so he could assist her with paying bills once her vision began deteriorating. That account had survivorship provisions, though she never truly grasped what that phrase meant back then. Once she dies, that checking account, which could contain a significant chunk of her savings, doesn't pass through her will whatsoever. It flows directly to her eldest son, entirely and instantly, regardless of what the will states about equal distribution. The remaining 2 children may never receive a dime of that money, and by the time somebody figures out what took place, it's already beyond repair. This isn't some uncommon nightmare scenario. This exact circumstance unfolds in households across America every single year, and it destroys family bonds, sometimes forever, over something that might have been prevented through one basic discussion and the correct documents. Now, let's discuss access, because this is where matters can turn awkward quickly. Once an individual becomes a joint owner on your account, they're free to pull out funds whenever they want for whatever purpose, without seeking your permission beforehand and without informing you afterward. Usually that's fine. Loved ones trust one another. But faith and pure intentions don't necessarily shield you the way you might expect, particularly when someone is dealing with their own money troubles. Suppose your son gets placed on your account to lend a hand, and 12 months later he hits a tough stretch, maybe losing his job, going through a split, or facing surprise medical costs. Here's a fact many folks aren't aware of. In numerous instances, lenders and collection agencies pursuing your son can genuinely tap into that joint account because from a legal standpoint, he holds ownership of some of the funds within it. Even if each dollar in it originated from you, if he gets taken to court or if he's in the middle of a divorce and that account becomes part of the case, your retirement nest egg could get tangled up in another person's monetary or legal problems through absolutely no wrongdoing on your part. And then comes the topic nobody wishes to consider, yet we must address it truthfully, because the figures are far too grave to overlook. Per studies from AARP, financial abuse costs elderly Americans approximately $28 billion each and every year. And what's disturbing is that the bulk of that cash, roughly 70% of it, is stolen not by outsiders or con artists phoning from abroad, but by someone the target already knows and relies upon. A relative, a caretaker, a companion. The Consumer Financial Protection Bureau has discovered that when the individual behind the financial abuse is someone close to the target, the typical sum stolen is considerably larger than when it's a stranger running a con. A joint bank account, regrettably, can turn into one of the smoothest routes for that type of abuse to unfold, because there's no warning sign, no strange wire going to some unfamiliar nation, nothing that sets off a bank's anti-fraud systems. It's merely a relative holding a debit card slowly pulling out money bit by bit. And since their name is officially on the account, the bank sees no cause to raise concerns. The FBI stated that over 88,000 Americans older than 60 fell prey to financial fraud plots during one recent year, with typical losses exceeding $35,000 per individual. And that number doesn't even factor in the gradual, quiet type of abuse that unfolds inside households through accounts exactly like the ones we're discussing here today. I want to make one thing perfectly clear before we continue. This video isn't about being suspicious of your kids or your partner or the individuals you cherish. Most households that establish joint accounts do so with the finest of intentions, and typically, nothing negative ever occurs. This video is about grasping precisely what you're committing to, so that if trouble does eventually arise, whether that's fraud, a family disagreement, a divorce, a court case, or a plain misinterpretation regarding who inherits what once you're gone, you've already shielded yourself beforehand. A little prevention right here can spare you years of legal frustration, family bitterness, and monetary damage. Let's discuss another matter that surprises folks. What occurs to a joint account when one of the account holders dies? Many individuals believe that upon the death of their partner or parent, the bank will just carry on running things as usual, or that all matters get resolved without difficulty. In truth, banks adhere to very particular procedures they observe, and depending on the way the account is arranged, you could discover yourself briefly cut off from money you urgently require for burial expenses or urgent bills. As the bank confirms documents, death certificates, and account ownership details. On the flip side, if the account carries the incorrect variety of joint ownership setup, it may skip over a thoughtfully drafted will altogether, transferring to whichever name is on that account, rather than being handed out the way the deceased truly wanted. Neither result sits well if you weren't ready for it, and each is remarkably widespread precisely because most individuals never sit down and request their bank to clarify in ordinary terms precisely which type of joint account they possess and what becomes of it upon somebody's death. Here's another twist that's growing more significant with each passing year: Medicaid and long-term care planning matters. Should you or your partner ever need to submit an application to Medicaid to assist with nursing home or extended care expenses, the government reviews your monetary history, frequently reaching back 5 years to look for movements of funds that might appear to be efforts to conceal wealth in order to become eligible for aid. A joint account tangles this situation dramatically because every dollar within that account could potentially be treated as owned by both parties for the sake of that look-back window, even if merely one individual actually deposited a single cent into it. Households that place a child on an account for ease of use without grasping the Medicaid consequences occasionally discover themselves confronting fines, hold-ups, or outright ineligibility windows when they require extended care assistance the most, just because of how that account was arranged years back. This ranks among those cases where a choice that appeared totally innocent originally can return to inflict genuine financial anguish later on, at the precise moment your household can least handle it. So, what's the other option? I'm not advising you to never place anybody on your accounts or to manage everything totally solo. For many older adults, having a reliable individual who can jump in and offer assistance is enormously helpful, particularly as health shifts or memory troubles start to worry them. The important thing is picking the correct instrument for the correct purpose, rather than falling back on a complete joint account simply because that's the choice the bank employee brings up first. A durable power of attorney, as one example, permits a trustworthy person to handle your finances for you without turning them into a legal co-owner of your funds. That indicates they're able to settle your bills, manage your banking transactions, and jump in when required. Yet the funds legally stay completely in your name. They're shielded from their lenders or courtroom problems, and they distribute according to your will or trust after you're gone, not immediately to whoever ended up being placed on the account. Numerous banks additionally provide what's referred to as a payable on death arrangement, occasionally shortened to POD, which permits you to designate a beneficiary who obtains the account funds right away following your death without needing to enter probate, but without granting that individual any access or ownership while you remain alive. This one option resolves an enormous portion of the issues we've discussed here today because the individual receives the funds easily and promptly once you're gone. Yet they possess zero capability to touch it, mishandle it, or subject it to their personal money troubles while you're still around. Banks have additionally begun launching something known as trusted contact designations, which is worth understanding as we move deeper into 2026. This is not someone who has any ability to reach your funds. It's just an individual the bank has permission to phone if they detect strange behavior on your account, indications of potential fraud, or warning signs that something could be amiss, particularly if they suspect cognitive impairment or abuse could be taking place. It's a bonus layer of safeguarding that runs you nothing and modifies nothing regarding who owns your funds. Yet it provides your bank one additional method to spot trouble sooner, before actual harm occurs. As financial institutions face growing demands to boost fraud protection for elderly clients, these trusted contact initiatives are turning up more frequently and more powerful than they were just a handful of years back. And it's worthwhile to inquire with your bank straight up if they have one available. Now here's a query worth posing to yourself candidly. Are you truly aware right this moment today what variety of joint account you possess? Numerous individuals who established these accounts years or perhaps decades in the past couldn't inform you whether theirs carries rights of survivorship, whether it's a legitimate joint account or a convenience setup, or what their bank's exact policy is regarding managing the account following a death. That doubt is precisely the opening where issues creep in. The remedy doesn't demand a lawyer or a complex procedure. It calls for a single telephone call or a single trip to your bank where you request them straight up to describe in plain English exactly the way your account is titled, what privileges the other individual on it holds, and what becomes of that account the instant one owner dies. Obtain the answer in writing whenever possible. Match it up against what your will or estate plan indicates. If there's a discrepancy between what your will means to do and what your account will genuinely execute, you still have time right this moment to correct it. But that opportunity shuts the second something occurs to you. And at that moment, nothing is reversible. I'd also like to bring up something plenty of households neglect: communication. 50% of the heartbreaking scenarios stemming from joint accounts don't arise because anyone acted with bad intent. They arise because nobody discussed it in the open. A parent presumes their kids understand how the accounts are structured. The kids presume everything will get split fairly because that's what mom or dad consistently promised. Nobody examines the real documents until following a funeral, when feelings are already elevated and money turns into a sore, uncomfortable topic piled atop mourning. If you hold a joint account alongside someone, or you're weighing adding someone to one, hold a candid discussion with the remainder of your family regarding your reasons, and confirm everybody grasps what it truly entails. It may seem awkward for 5 minutes now. It's a lot less awkward than a courtroom battle or a broken family tie down the line. There's one additional item I need you to catch, and it's the piece most videos on this subject entirely bypass, though it might represent the single biggest point in everything we've talked about up to now. Even should you handle it all correctly, even if you pick the correct account variety, arrange power of attorney properly, and hold all the necessary discussions with your relatives, there remains one slip-up that silently unravels all of that protection, and it has nothing whatsoever to do with documents. It concerns how frequently you personally review your own statements. Financial institutions are obligated to mark specific categories of suspicious behavior, but the boundary separating a routine withdrawal from a worrisome one is often invisible from their end. A relative withdrawing modest sums on a regular basis typically doesn't set off any fraud warning because none of it appears strange to a bank's monitoring platform. The sole individual who can genuinely spot that trend early is you. Simply by scanning your own statement each month, being aware of roughly what should be arriving and departing, and raising questions the second something feels even a bit off. This one practice, examining your statements consistently and not merely presuming everything's okay, is the divide between spotting an issue after a few $100s and uncovering it after tens of thousands of dollars have already vanished. It costs zero. It requires minutes, and it's the safety cushion that grabs whatever every other defense may skip. Let me share one further scenario, because this one surfaces far more frequently than folks anticipate, especially among wed pairs who've spent decades together. A husband and wife split a joint checking account the identical way they've done for 40 years. They've forever relied on one another entirely regarding finances, and there's never been any cause to second-guess it. But later in life, one partner starts displaying initial hints of memory decline. Perhaps nothing extreme just yet, merely tiny slip-ups now and then. Around that identical period, an unfamiliar caller phones, claiming to represent the bank's fraud unit, cautioning that the account has been breached and that funds have to be relocated right away to a secure account to shield them. This ranks among the fastest-growing scams aimed at older Americans today, and it succeeds precisely because it comes across as authoritative, pressing, and shielding rather than menacing. The partner with memory challenges, wishing to act properly and safeguard the household's funds, obeys the directions and moves a substantial amount before anybody else even understands what took place. Given that it's a joint account, the other partner possesses equally the legal claim to that money. Yet at the time, they had no clue the phone call was underway, no window to intervene, and no notification from the bank, because from a technical standpoint, an approved account owner sanctioned the movement themselves. This is exactly the type of circumstance that trusted contact initiatives and consistent account tracking exist to intercept, but solely when they've genuinely been arranged in advance. Con artists have grown markedly craftier moving into 2026, frequently employing tools that can imitate recognizable voices or caller identification data to render these phone calls seem even more believable. Which means a routine of verifying twice with your bank yourself, using a phone number you find independently rather than one supplied to you through the call, more crucial than at any prior point. It's additionally worth grasping how joint bank accounts connect with other elements of your monetary situation, because funds seldom sit in only one location. Retirement funds, such as 401k plans and IRAs, together with life insurance coverage, don't really transfer through a joint bank account or even via a will whatsoever. They transfer straight to whichever party is designated as the beneficiary on the account paperwork itself, no matter what your will indicates, and no matter who's listed on your checking or savings account.